Friends, welcome to this interesting video, 7 ideas that are foundational to financial statements. Quite often, people who don't have any accounting and finance background are always intimidated by the financial statements. They feel that they're very complex to understand. But remember, if you master simply 7 ideas, you can master financial statements. So welcome to this video. Let me present to you a very simple model of any business. Any business that we can think of requires resources. Resources, of course, would include infrastructure such as office, plant and equipment, machinery, laptops, and so on. It also may require certain resources like energy, raw materials, packing materials, various kinds of services. Only with these resources, it can really deliver value to its customers. For it to be able to acquire those resources, it needs money. Unfortunately, while a company has been given various rights to be in business, which I have discussed in some other videos, it of course doesn't have the right to print money. And because it can't print money, it has to rely on some other entities to source that money. We can call it as sources of funds. Let us elaborate on this very simple idea. If you visualize any business, at any point of time, it will have certain resources which are available with it. These resources are not yet consumed and have economic value. What we mean by economic value is that these resources can be put to use for a constructive use. These resources, which are not yet consumed and are available with the enterprise, can be called as assets of the business. Now, as we have already discussed, resources are financed by sources of funds. Now, sources of funds can be broadly twofold. A set of people who are willing to finance us, finance the business in the form of money, and another source who are willing to supply goods and services to an enterprise by offering us credit. Now, when we source money by way of investments into the business, investments into shares of the company, we call it as equity. When we raise money by way of borrowings, we call it as liability. In addition, whenever we have sourced goods and services by seeking credit, say of 30 days or 90 days as the case may be, we are also creating liabilities. Now friends, you have realized that out of those 7 ideas, unknowingly we have already discussed 3 ideas. Which are those 3 ideas? Assets, equity, and liabilities. Of course, you will find many other videos that I have created in which I have elaborated those ideas further. But the purpose of this video is to just give you a quick framework in which you can understand these 7 ideas together, with which you can easily understand financial statements. Also, while there are a set of resources which we have not yet used up, as we have already called as assets, there are also resources that we have already consumed. For example, the energy which is already consumed, raw materials which are already consumed, people's time and talent which is already used up, all can be called as resources consumed. And all these resources consumed together are called as expenses, right? Now, we don't consume these resources for the sake of it. We actually consume them with the idea of delivering some valuable goods and services to our own customers. Now, when we start delivering those goods and services to our customers, it gives rise to what is called as income. This income is recorded as soon as we have delivered contractually the goods and services that we have promised our customers. Similarly, expenses are recorded as soon as we have acquired those resources and consumed them, and the accountants don't wait for actual payment to happen. Now remember, expenses are recorded based on the principle of usage or accrual and not based on payment. So an expense would be recorded even if the payment is yet to be made. Similarly, an income would be recorded even if the money is yet to be collected from the customers. So here the concept of expense and income is linked with the delivery based on the contractual obligations. Now remember, in addition to these 5 terms that have already come up, there are 2 more interesting and important terms. You can see them right at the bottom: inflow and outflow. This inflow and outflow is based on the actual movement of money. Money actually coming in can be called as inflow. Money actually going out is the outflow. Now remember, when we acquire an asset also there is an outflow that happens. When we incur expenses also, someday or the other an outflow is going to happen. Similarly, when we raise money by way of equity and liabilities, inflow happens. Similarly, when we sell goods to a customer, someday or the other the concept of inflow is going to kick in. Let's elaborate a little further. We have already discussed these 7 ideas, but I also want to talk about an 8th idea that we are all familiar with, and that 8th idea is the profit. Profit simply is the difference between income minus expenses. Remember, this profit belongs to the people who have invested in equity, and therefore this profit, to the extent it is not distributed to the equity owners, to the shareholders as we call them, is also going to add into that equity under the title reserves. You may have heard about it, or you may have also heard about a term called as retained earnings. So this profit keeps on adding to these retained earnings if it is not distributed. Now let's quickly look at how these 7 ideas are reported. Now remember, the assets, equity and liabilities are stock ideas, which means we can measure them at any point of time. We can report assets at a point of time, we can report the equity at any point of time, we can report the liabilities at any point of time. But remember, from point to point, from day to day, the assets, equity and liabilities can undergo a change. For example, the inventory that you have today may not be the same inventory tomorrow. The inventory may have got added up or depleted, isn't it? So therefore, equity, liabilities and assets are measured at any point of time and are reported typically at the end of a year or a quarter, right? On the other hand, income and expenses and inflow and outflow are measured and reported for a period like a quarter or an year, right? And the same thing is true about profits. Friends, with these simple 7 ideas, as I'm going to show you on the next slide, we can clearly understand the financial statements because it is these 7 ideas that are actually mapped to the financial statements, as we're going to see on the next slide. So we have just seen these 7 ideas: income, expenses, inflow, outflow, assets, equity and liabilities. Now, of course, we also discussed about this idea of profit, which is derived from the words income and expenses. Now, income, expenses and profit is reported on statement of profit and loss. Inflow and outflow is reported on the cash flow statement. Assets, equity and liabilities are reported on the balance sheet. Of course, I have created more detailed videos on each of these 3 financial statements that I request you to explore. I would also provide links to these in the description box so that you can explore them more. But I thought I'll give you a summary in just 8-9 minutes, which gives you a framework of how we can easily understand these financial statements. For more such videos, do explore our channel, Dr. Abhijit Fadnis. Thank you so much. Take care and stay safe.